Good afternoon. Welcome to our session on the post-pandemic economy. Today's program is a collaborative effort between the Gateway Chamber and the Independent Colleges and Universities for New Jersey. My name is Lou Manzione, and along with Jim Coyle, president of the Gateway Chamber, we will be the co-hosts of today's events. The independent colleges were responsible for arranging the speakers for today, and we are pleased we had the support of our institutions, as well as our partner companies in providing an outstanding panel that we have for today's discussion. I sincerely thank our speakers for agreeing to share their time and their insights with us, and I thank our sponsors for their financial support. I would like to spend a minute or two introducing you to the 14 institutions of our Association of Independent Colleges. They provide a diversity of educational programs, mission, history, and size, as well as geographic location across the state of New Jersey. They all share a focus on student success and high levels of student support. We also share an emphasis on collaborations with industry. We have a board that represents over 50 of New Jersey's top companies from all major industry sectors. We celebrate the diversity of our 65,000 students. Over 40% of our students are first-generation college students. Close to 40% are eligible for federal Pell Grants for low-income students. 6 of our 14 institutions have the designation as a minority-serving institution. We believe we play a vital role in social equity. Several of our institutions are among the best in the nation in economic mobility. Bloomfield College has several times rated in the top 10 in the nation in economic mobility. Another 4 to 5 of our institutions are in the top 50 in the United States in economic mobility. Please remember, there's about 4,000 universities in the United States. The mission of the Association of Independent Colleges and Universities is to promote awareness of the institutions of the independent sector and to develop support for our students from state, corporate, and philanthropic sources. We support our students through advocacy in Trenton. Our offices are directly opposite the state capitol. We provide scholarships and financial aid and connections to the professions, internships, mentoring, job shadowing with our corporate partners. We are proud of the contributions that our institutions make to the state through college graduates, world-class research, engagement with industry, and community support. We seek connections with organizations such as the Gateway Chamber to ensure that we are not only relevant to the New Jersey economy, but a critical component of the state's 21st century talent pipeline. I'd like to just quickly cover one way that you can get engaged with our institutions, with our students, with the association, is that become an affiliate member for a small annual fee. $500 for a small company, $1,000 for a mid-sized company. It gives you access to our talent pool of more than 65,000 students, access to internships, to mentoring. It's been very popular with the companies that we've rolled it out with. In many companies, we have more mentors than we have students. That's how many working professionals have been interested in mentoring students. Job shadowing, professional roundtables. We just had 2 in the accounting industry, one provided by CohnReznick, the other by Ernst & Young. Engage with our academic programs. We encourage alignment with what the workforce needs are and look to stay connected to industry. Network with our campus leadership, our independent board of trustees, college board of trustees, which is 50 plus major New Jersey companies. We use the funds to support emergency aid for funding. And unfortunately, we're at a time when there's great need for emergency aid to keep students on track to their degree. If they run into an unforeseen financial obstacle, we use these funds to help them out. In summary, I'd like to say that we support the institutions and the students of the independent colleges and universities of New Jersey, and therefore help prepare the future educated workforce of the state. We welcome you to get involved. please contact me at manzione@njcolleges.org. Also, visit our website at njcolleges.org. At this point, I would like to thank you for being with us today. I would like to introduce my co-host and who will be our moderator for the session, Tim Coyle, president of the Gateway Chamber. Tim is an economist. I think his specialty is econometrics, a very relevant topic. So Jim, I will turn it over to you. Thank you so much, everyone.
Great, and thank you, Lou. I really appreciate it. We have such a great partnership with the Independent Colleges of New Jersey, and this panel today is just one example of the things that we do together. And so I would echo Lou and encourage more people to get involved. We're involved because, frankly, the students who graduate from these colleges and universities end up going to work for the businesses here in New Jersey. So my name again is Jim Coyle. I am the president of the Gateway Regional Chamber of Commerce, and I want to welcome you to our 5th annual Economic Outlook Summit. Now, the previous 4 have always been in person, but going virtual this year because of COVID actually gives us the opportunity to appeal to a much wider audience. And so we have people logging in from all over the country because we have such a great panel of speakers. And I'm going to take just a moment and introduce our speakers because I'm sure you will agree with me that we're going to have some terrific discussion today. So first up, we are going to have Nigel Galt, who is the chief economist of EY Parthenon. EY stands for Ernst & Young. Now, if you listen closely to Nigel, you'll probably figure out that he's not from around here. Nigel is a Brit, grew up in the UK, and I asked him, so why did you want to become an economist? You know, since I'm an economist, I like to ask this question to other economists. And he said it was because he had a real analytical mind and he wanted to learn how things work. You know, why unemployment rates were what they were, why foreign exchange rates changed. And so as an undergraduate at Cambridge, he started his study of macroeconomics, went on to Harvard to get his PhD, and most recently has, as I say, been working for Ernst & Young Parthenon. Now, at Parthenon, he provides his clients with insights into economic developments that guide their operations, their investments, and their acquisitions. So he is dealing with issues all over the world and providing just some great guidance for businesses and their operations. So following Nigel, we are going to have Bill Dudley, who is the senior research scholar at the Griswold Center at Princeton University. So Bill grew up in Massachusetts, but he's lived in Cranford so long, Cranford, New Jersey, right down the road from my office, that this has long been his home. Bill studied economics pretty much for the same reasons that Nigel did. He had a strong analytical mind and he wanted to understand how things work. After finishing his PhD at Berkeley, he went on to work at Goldman Sachs, working his way up to become their chief economist. He was then tapped to become the president of the New York Federal Reserve Bank and helped guide the bank through the Great Recession, and served as vice chairman of the Federal Open Markets Committee. So he has some really great insight into the workings of Fed policy and its dance with government economic policy. And we really want him to give us some insight into how that might play out with a new administration. And then finally, we are going to turn to George Calhoun, who is the founder and director of the Quantitative Finance Program at the Stevens Institute for Technology. So George is going to give us a different perspective on the economic outlook, and one that I think is going to be very valuable to a lot of us in the audience, because he's going to talk about the stock market and how it might react to changes in economic policy and the economic outlook. So I think, as I say, we have a really good panel. George actually has a very interesting background because he spent 25 years in the wireless industry. So all of these mobile phones that we have, he was involved in developing a lot of the technology that has formed this mobile communication system. And I think that served him really well in developing quantitative finance for the students at Stevens, and who ultimately go on to work on Wall Street. George has his PhD from the Wharton School. Now, procedural note. So we're going to go through the presentations, and then we're going to have a question and answer period. So for those of you who are watching this on YouTube, if you have questions, please type them into the chat box, and those will be sent to me, and we can address them with our speakers. So with that, I think, Nigel, we will turn the floor over to you.
Thank you very much, Jim. Good afternoon, everybody. Just 1 second. I'm going to share my screen with everybody. Nope. There we go. Okay. So what I'd like to do to start off is to just give a picture of where we stand with the economy. Look at the evidence of how much the pandemic has damaged activity in the US economy and the extent to which we've come back so far. So let's take a look here at GDP by production sector in the second and third quarters of this year. And I'm comparing here with the fourth quarter of 2019. So that is before the pandemic. The data for the second quarter is actual numbers. Overall GDP for the third quarter is also actual, and the Q3 details are EY Parthenon estimates. So overall, as of the second quarter, GDP was off about 10% from its pre-COVID level. But by the third quarter, we were down just 3%. So we'd regained about 2/3 of the ground lost in the first half of the year in the third quarter. So still far from normal, and the variation across sectors in the damages is enormous. So off to the left-hand side of the chart, we have the hardest hit sectors with declines in some cases, as much as 60% in the second quarter. These are a collection of service sectors that really can't get close to normal activity without a vaccine that makes normal activities possible again. So think of arts, entertainment, and recreation, accommodation, food services, airline transportation. Now, the good news on the Pfizer vaccine this week is very encouraging for an eventual recovery in these sectors. But it's hard to envisage widespread availability of the vaccine before about around the middle of 2021. Now, as spending has shifted away from these discretionary service sectors, there's been a shift in spending towards some discretionary goods sectors. So hence retail activity overall is about, in Q3, about 7% above its pre-COVID level. Food at home was a big winner with less eating out. Building materials, a big winner. People spending more time at home, wanted to make that home as comfortable as possible. But of course, within retail, we've had a huge shift from brick and mortar sales to e-commerce. Now, another way to break down the overall GDP picture is to look at it by spending categories rather than by production. Now, here we do have official data all the way through the third quarter. So this chart has the same idea. It's comparing the second and third quarters of this year with the fourth quarter of 2019. And spending on Consumer goods and housing have fared the best. Consumer durable spending is up about 12%, non-durables about 4%, and residential buildings up about 5%. So low interest rates, a move to the suburbs, the boom in housing improvements has all helped the residential side. Also on the goods side, business equipment spending is almost back to where it was. It's almost recovered. It's off just 2% now. So the big losers, consumer services, spending still off about 8%, and non-residential structures were off about 14% as of the third quarter. Now, a chunk of that is due to lower oil and gas exploration due to the plunging oil prices. But even taking that out, non-residential building is off about 7%. So that would be what you could think of as being commercial construction. So work from home's undermined office building. The e-commerce shift has hit brick and mortar retail, and the plunge in discretionary services spending has hit hotels, motels, restaurants, and construction. The only sector that's held up reasonably well is, not surprisingly, warehouses. They're helped by the shift to e-commerce. So where do we go from here? Where do we go next? So let's focus on the big picture here. This is looking at overall GDP. So the chart on the left is looking at real GDP with the starting point of the fourth quarter of 2019. So that's pre-COVID. So that's the starting point. And then there's a dashed line sloping up to the right that shows a trend growth path. Now, the actual part of GDP through the third quarter, so that's the start of the blue line, that does look very much like the beginnings of a V. We had a huge decline in activity in the second quarter and a big bounce in the third quarter. That was still about 4% below trend. But those, I think, were the easy gains. I think the easy gains were behind us, and they occurred in the third quarter. Progress has slowed during the course of the third quarter, and we now face rapidly rising virus cases as we approach the winter, and fiscal stimulus is fading. As we go into the winter, whether through formal restrictions on normal activities or simply voluntary actions by individuals behaving more cautiously, the current virus wave is going to slow down the economy. Could even temporarily, in a worst case, send us into reverse. Now, looking forward, we have three potential scenarios which are driven by how successfully we deal with the virus. So our base case scenario, which is the blue line, we make much slower progress on the recovery until mid-2021, at which point we assume a vaccine is widely available. The prospect has become more likely after the Pfizer news. In the optimistic scenario, we do better over the winter months in suppressing the virus through improved treatments, and a vaccine, we assume there the vaccine comes more quickly. The pessimistic case, that assumes a very severe virus wave over the winter months, which causes a temporary reversal of the recovery, and then a vaccine arriving in mid-2021, but that vaccine assumed to be less effective than in the base case or the optimistic case. Now, of course, we could have a potential mix of these scenarios going forward. We could start down the pessimistic path and then have a very effective vaccine available by the middle of next year, and at which point we could move up very sharply to the base case or even possibly to the optimistic case. So those are potential scenarios moving forward. I'd like to conclude just with a few comments on some bigger picture, longer term issues and trends that I think will be there even after we get to the point where we have a vaccine widely available. The way I look at it, COVID-19 has accelerated, accentuated and accelerated some key trends and tensions that were already clearly evident in the global economy. The trend of global growth, I think, was already slowing. reflecting slower growth in working age populations around the world and declining working age populations in some cases. And I think probably the trend of growth is likely to slow further as a result of COVID-19. I think supply chains are going to shorten, and in terms of business planning and thinking, the notion of just in case planning, precautionary planning, I think is going to come to the forefront instead of the sort of just in time planning of the past. And COVID probably will give more impetus to the deglobalization move, nations looking a bit more inward, than in the past. Another trend, I think, accentuated by COVID, inequality has risen further. Poorer nations and poorer households have been hit hardest. The hardest hit workers are lower paid workers in the service sector. In the US, for example, the employment of high income earners, that's people earning more than 60,000, that's estimated as of September to be roughly back where it was in January. Whereas employment of low income workers, people earning below around $27,000 a year, that's still thought to be about 20% below its starting point. So the effect on income has been to accentuate inequality. And if we're thinking about wealth, stock market wealth has held up very well, so have house prices. So the better off have seen their wealth largely intact. A third key point here, the pace of digitalization has really accelerated as a result of COVID. The market dominance of the tech sector has been reinforced, shift to e-commerce accelerated, and working from home permanently increased, not at present levels, but likely increased much above what it used to be. And the same story for business travel in reverse, business travel permanently reduced. We've discovered that we can do so much remotely that previously we thought had to be in person, that these shifts will remain even after the immediate COVID threat has gone. The final point, fiscal and monetary policy have moved even further into uncharted territory. Now, I'm not going to say any more on that subject because policy is going to be the focus of our next speaker. So with that, I'll conclude and pass you back to Jim Coyle.
Great. Thanks so much, Nigel. I really appreciate that. It was a very insightful presentation. A lot of data there presented in a way that was pretty easy to understand. So, Bill, we are spiking in COVID infections. We have turmoil in government. We have a new administration coming in, which may or may not have some policies that reverse where we've been going the last 4 years. How's this going to play out in the economy, and how, because I'm not going to pass up on the expertise that you give, how is the Federal Reserve going to try to keep everything on track while everybody else is going crazy?
Thank you, Jim. Let me start where Nigel left off. Nigel has a great analysis of what's actually happened in the economy. And the question is, well, why did we get that big bounce back in economic activity in the third quarter? And one was we bent the curve of the pandemic for a while, which allowed reopening, businesses to restart. And two, we had an unprecedented amount of fiscal and monetary policy stimulus. The three things that I would note about that stimulus at both the monetary policy and the fiscal level was: one, the speed in which it was enacted; two, the size; and three, the scope. If you look at the speed, it's incredibly extraordinary how rapid the policy response occurred. The World Health Organization declared the coronavirus a worldwide pandemic on March 11th. The Federal Reserve cut short-term interest rates to zero on March 15th. 4 days later. The CARES Act, a $2 trillion fiscal stimulus program, was signed into law on March 27th, just about 2 weeks after the WHO declared the coronavirus a pandemic. So a tremendous amount of policy stimulus got into the system very, very quickly. In terms of size, you just look at the CARES Act, the $2 trillion fiscal program. This is more than double the size of the fiscal stimulus package that was enacted by the Obama administration following the great financial crisis. Scope, that applies to both fiscal and monetary policy. On the fiscal side, we had some novel programs. The Paycheck Protection Program, which basically lent money to businesses that were with the loans forgiven as long as people kept those people employed. Unemployment compensation benefits that were topped up with an additional $600 a month. So some workers, low-wage workers, were actually making more money unemployed than when they were employed. Backstops of $454 billion from the Treasury to the Fed. So the Federal Reserve had plenty of credit support so it could broadly backstop financial markets. And a whole host of other odds and ends, for example, aid to the airline industry, state and local governments, healthcare, et cetera. Monetary policy also was extraordinarily broad in its scope. Not only did the Fed cut interest rates to zero, engaged in a wide variety of special liquidity facilities that went further than what we saw during the great financial crisis. Backstops for the corporate bond market, for the municipal bond market, the asset-backed securities market, for the commercial paper market, for the money market mutual fund industry, and large dollar swap lines to foreign central banks so that their foreign banks could continue to fund their dollar book of assets. So the question is, why did this happen so fast compared to the great financial crisis, which sort of occurred in slow motion by comparison? Well, the first is the shock occurred very, very fast. We went from a very good economy in February to a really horrible economy in March. And I don't think we've ever had a transition that's been that abrupt in US history. Second, the enemy this time was quite different. The enemy in 2007 and 2008 were large financial institutions that had behaved badly. And so there wasn't a lot of appetite to intervene early to bail those institutions out. This time, the enemy was quite different. It was a coronavirus pandemic. And so there was no political controversy in terms of engaging in massive monetary policy and fiscal policy stimulus. And there's no question that this stimulus really helped. Fiscal stimulus put money in people's pockets, and you can see in Nigel's slides how much it ended up supporting things like housing and consumer durables. And the fact that consumer spending has held up so well is because we got just such large fiscal stimulus. And it also, you can see it showed up in terms of markets. The reason why the stock market is doing so well is because the Federal Reserve restored market function. The corporate bond market was under a tremendous amount of stress in March and April, as was the Treasury market, the mortgage-backed securities market. But these Fed programs basically restored these markets back to health. So the question now is, where do we go from here? We're at a pretty tricky point now in terms of the economic outlook. The news has been pretty good over the last few months if you look at the economic data, but the pandemic is reaccelerating. So social distancing at a minimum is going to increase. And the fiscal policy stimulus basically ended at the end of July in most cases, when the $600 weekly supplemental benefits for unemployment compensation ended. So what happens from here? Well, in terms of the policy front, there's no question that the Federal Reserve could still do more monetary policy stimulus. The Federal Reserve could increase the size of its asset purchases. It could ease the terms and conditions for the liquidity programs that it has in place. It's already been pretty aggressive in terms of committing to keep short-term interest rates low for long. The Fed has basically said now that they're not going to raise short-term rates until three conditions are fulfilled. One, we get back to maximum sustainable employment. Two, we get back to 2% inflation. And three, they expect inflation to rise above 2%. This is an extraordinary commitment, which it really implies that the Federal Reserve is not likely to tighten monetary policy for several years at a minimum. What they're doing now is very different than in the past. In the past, they tried to get to a neutral monetary policy at the same time that the economy got to full employment. Now they're basically keeping monetary policy super accommodative, even as the economy gets to full employment. So there's a lot more stimulus in the system. The other things the Fed could do is they could engage in yield curve control, where they actually decided to peg long-term interest rates at lower levels. Not really a great need to do that today with 10-year Treasury note yields below 1%. But if you saw a backup in longer term Treasury rates, it's possible the Fed could intervene by doing yield curve control and basically saying, we'll buy whatever Treasuries we need to keep Treasury rates from rising above that level. So the Fed could do more. The problem is that even if the Fed did more, would it have much consequence for how the economy actually behaves? And I think the answer to that is no. The efficacy of further monetary policy easing is quite limited at this point. And the reason for that is that short-term and long-term rates are already extraordinarily low. The 10-year Treasury note yield below 1%, 30-year fixed rate mortgages around 3%. And the interest rate sensitive sectors, as Nigel pointed out in his analysis, are already very strong. We've seen a big rise in motor vehicle sales. We've seen a surge in new home sales. So the interest rate sensitive sectors have already responded to the Fed's monetary policy easing. Even if you pushed interest rates down by another 0.5%, it's hard to believe it would have much effect on the real economy. And finally, financial conditions, and this is something that George will get into in a minute, are extremely accommodative. Stock prices are near an all-time high. Credit spreads are extraordinarily narrow given the economic situation that we're in. So at the end of the day, what I would conclude is monetary policy has mostly done what it can do at this point. So that's really why this whole focus now is turned to fiscal policy. We fell off a fiscal cliff at the end of July. It hasn't had much consequence yet because we had a reopening that led to a rise in economic activity. And the size of the fiscal stimulus that we had in the second quarter through July was so extraordinary that it raised this household savings rate, so people actually had some money left over to sustain their spending. But with the pandemic worsening, that fiscal stimulus more and more in the rearview mirror, it's really important now to have further fiscal stimulus to bolster this economy as we go forward. This isn't just my view. This is a view of Fed officials more broadly. Chairman Powell in his public press conference remarks has made it very clear that more fiscal stimulus is needed at this point. And I think, while he won't say that the Fed's out of ammunition, I think he's tacitly admitting that there isn't that much more that monetary policy can do at this point. Unfortunately, the fiscal policy outlook is at best extraordinarily cloudy. As you saw prior to the election, there were negotiations between the Republicans and the Democrats, and there was no deal before the election. Who has control of the US Senate post this election is still in doubt. The Georgia runoff elections are going to be very important in settling that. And so I think that the prospects for fiscal stimulus in this politically charged environment are quite low before Inauguration Day in late January. Now it's possible that cooler heads will prevail, and what's best for the country will drive the political calculus. But I do think that the Georgia Senate runoff elections are actually a little bit unfortunate because it makes the whole situation more politicized. And I think that makes the bar to doing further fiscal stimulus in the near term more difficult. So I think we've had some good economic news up to now, but I think like Nigel, I'm a little nervous about where we go from here. And like Nigel, we're waiting for the vaccine not just to arrive, but to be widely disseminated through the population. And that's going to take some time. So the next 8 or 9 months, I think, are going to be pretty difficult. And I'm hoping that more fiscal stimulus does, in fact, arrive.
Okay, thanks so much, Bill. Really appreciate that insight. And so let's ask George Calhoun to give us a little bit of insight in how the stock market has been reacting, how it might react going forward, and why. George, you are still muted.
Okay, you can see me though. So giving insight on the stock market is one of those jobs that is easy to look foolish because it's very hard to do. I'm gonna I'm not an economist, so I don't have kind of the ability to rely on the stable structural characteristics of the economy to talk. I have to deal with the stock market, which is not a stable system always. In fact, it's a mutating system and its behavior changes over time. But it's fun. And let me make a few comments for you. I will load up a little bit of. So can you see that, guys? Yes, okay, good. So first, real quick, the markets today are high-tech systems that I guess everybody is increasingly aware of, and they move very, very fast. The competitive sort of threshold for being competitive in the market today for many types of investors is estimated to be down below 1 millisecond, meaning if you're slow or fast by that amount, you're going to have the advantage in the trade sometimes. And about half of the trades in the market today are algorithmic trades or coming through computer engineered systems of some kind. They may be have varying degrees of a computer drive, of a human driving the computer system, but they are nevertheless highly mechanized. And this phenomenon, all these phenomena kind of drive us to a very short-term focus many times. And we've seen in the past week or two, the election roller coaster, which has been, if you just stand back from the stress of it and look at how the market has behaved, it's kind of fun. If you were watching the elections on election night, you probably at about 10 o'clock got this notice that the NASDAQ futures were suddenly up over 4%. And everybody was questioning, is this a Trump rally about to take the market on a ride upward? But a few hours later, it was almost all back, given back. In fact, the S&P 500 itself was down. Was this because it looked like Biden was going to win? Were people worried about that, or was it an uncertain outcome? And by the middle of the next day, it was again surging back up, a Biden rally, or maybe the common explanation I think that began to emerge in the press was that this was about gridlock, that it was beginning to be perceived that maybe there would be a government that had split control of the houses of Congress versus the presidency. And there's a trope in the financial analysis of the market that the market likes gridlock. It's not actually that true, or at least it's a mixed picture, but it's a very common statement. Over the next few days, as you begin to lengthen your perspective, you get away from the micro, the short term, it has become clear that at least it seems like the market is responding in a positive way to the slow reduction of uncertainty. The market, the election results drove a nice gain. And then, of course, the Pfizer vaccine news was something that everybody welcomed. And so we're up about 10% since the election. But I'd like to go a little bit more macro because I think that's the perspective of this, this forum. And I'm going to talk about three macro cycles, which are interesting, a little bit fun, and fairly well established. And one is the presidential cycle, the election cycle. I'll say more about that. The Federal Reserve has a cycle, as you will see in a second. And the general background of our current markets in an era of monetary, loose monetary policy, quantitative easing, sometimes called financial repression, I guess by people that don't like it. First, the presidential cycle. This is it's an extraordinary market anomaly. Year 3 of the presidential term is the year when almost all of the gains in the market over the 4-year presidential cycle occur. So that year 3 ended last January. We're now in year 4, and we're about to enter year 1. And if the pattern holds, this will be a flat market or a flat-ish market in the next year or so. And there's a view as to why that is, which is that typically the first half of the presidential cycle is when big things get done in Washington. Taxes get passed, stimulus events take place, new legislation, new regulation. This is just since 1972 to 2007, it's saying that most of the major tax legislation is front-loaded because the president comes in with a mandate, and that's when things happen legislative-wise that unsettle the market, and the market does seem to be a little bit hesitant when a lot of policy pieces are moving. As a side note, but I found this fascinating, this presidential term effect extends outside the United States. Every major market in the world shows the same pattern. Their elections are not synchronized with ours, but by golly, there you see it. They have a great year 3 and 4 of the American presidential cycle as well. The second sort of macro trend I'd talk about is the Federal Reserve, and this is probably the most amazing piece I've come across in the last little while, which is actually comes from the Federal Reserve itself. It's a staff report from a couple of economists. It's been followed up and confirmed by additional academics. Basically, it says that the market jumps when the Federal Reserve Open Market Committee meets. And this, the economists that studied it looked at the average one-day market return on the meeting days, the 24-hour period when the market, the Federal Open Market Committee met. And you can see the comparison. This phenomenon didn't really develop until the 1980s, but it has become a very distinctive phenomenon in the market. And strikingly, when you go back and add it all up, 80% of the stock returns since 1994, this was written in about 2012, 2013, I think, but there are other studies that follow the same pattern. 80% took place on those 8 or 10 days a year when the Federal Open Market Committee was active. And it didn't matter whether they were stimulative or non-stimulative or anti-stimulative. You can see whether they raised the funds rate, they decreased it, made no change. It was the day itself, it was the meeting of the Federal Reserve that drove the market. And I think that's one of the themes that has become stronger and stronger. We'll see. The third and last broad trend I'll call attention to, there's a phenomenon called the Great Moderation, which people identify as basically the couple of decades prior to the recession in 2008, 2009. One of the hallmark phrases of that era was from the head of the Fed at the time, Alan Greenspan, who worried in 1996, I think, about irrational exuberance and increased appetite for risk. But it was a natural development. The market was kind of going on its own momentum and developing this risk. The Fed did, of course, provide guide rails and try to tap on the brakes from time to time or stimulate if necessary, but they weren't really trying to create this situation. And this is what the market did in that time frame. It was up 770%. It was a long bull market. The market is today in a second long bull market. It's not quite it's not at 700% yet. Maybe it won't get there, but it's about tripled, more than tripled since the turn of the trend in 2009. And this is a different era. It's yes, the same thing. It's an increased appetite for risk that we see in the financial markets, but this is now, a lot of people would claim, I think it's so, that this is now an appetite that is being promoted by Fed policy, by monetary policy, not just the Fed, but many of the central banks around the world to encourage a shift of investor interest away from the bond market and towards the equity market. And it has underpinned a lot of what's happened in the last 10 years. And I think that's going to continue to be a big deal. anyhow, there's some stuff about me, but let me come back and unshare. And anyhow, talking real fast, there's a lot to say about these things, but I'll pause there and hand it back to Jim, and we can get questions.
Great, thanks so much, George. So we're going to go into the Q&A part. There have been quite a few questions that have been asked. So I will ask that, Bill, if you could unmute your screen, your mic, that'd be great. Okay, so the first question is, why are we seeing a spending increase when there are so many who can't afford the basics like food? It seems to be a real disconnect in the way things are going.
I can respond to that quick.
Go ahead, Nigel.
Yep. And then, just from the way the effects have affected different segments of the population, as I noted in my remarks, that the employment of people in upper income levels right now is pretty much back where it was in January. Employment of the lower income groups is way down. So there's been a very unequal distribution of the economic damage across different groups. And remember also that people in the upper income groups, if they still held on to their jobs, there's a lot of things that they're not spending on that they normally would spend on. So they're not spending on their vacations or on hotels or whatever. So they have a lot of potential spending power, in some cases increased by government stimulus, a lot of potential spending power that they've shifted away from discretionary services to discretionary goods. And so that's why we've seen strength in consumer durables, strength in the housing market. So I think it's very much a distributional thing of where the spending power is, that why we're seeing some parts of the economy, some parts of the goods economy doing so well.
Nigel's absolutely right. I mean, the coronavirus has had extraordinarily disparate impacts on low and moderate workers relative to the higher end, and depending on what occupation you're in. And I think, you can see some of the effects on the pandemic in terms of also what people want. Houses in New Jersey, not far from New York City, in the suburbs are actually, moving quite quickly because there are rich people in New York who don't want to be cooped up in the city with their families and their children. And so they're moving out to the suburbs. So people who have, financial assets, excess savings, are reallocating their, spending baskets because they have the wherewithal to do it. But people who are low and moderate income, who oftentimes have lost their job, don't have that same flexibility. And of course, for a while, the income on those low and moderate income households was cushioned by the unemployment compensation benefits with that $600 a week supplement. But that $600 a week supplement ended at the end of July. And so this disparity is probably actually widening as we speak.
Mm-hmm. Next question. The federal government is sitting on a mountain of debt. How important is that? Is that something that we need to worry about immediately, worry about eventually, or not worry about at all?
All economists say that there's no such thing as a free lunch. So if there was really no cost to the debt whatsoever, then let's just not pay any taxes. And nobody would think that was a good idea. So there is definitely a cost. But with interest rates as low as they are, with interest rates adjusted for inflation in negative territory, there's more fiscal headroom than what maybe we thought 15 or 20 years ago. And if you're ever going to use the fiscal lever, this is when you want to use it, when the economy is underperforming and there are excess resources in the economy that you can put to use. The cost of fiscal stimulus is much lower when you have excess slack in the economy, because the fiscal stimulus generates economic activity and you actually recover some of that cost of that fiscal activity through higher output and higher taxes. So look, there's no free lunch. We are going to have to service this debt down the road. As long as interest rates stay low, that's not a big problem. But I do think that there is going to be a problem, 3, 4, 5 years down the road when the Federal Reserve actually accomplishes its inflation objectives and then begins to tighten monetary policy. And then guess what's going to happen? Debt service costs are going to explode. The federal debt has tripled since 2007, more than tripled since 2007, and debt service costs haven't budged. And that's just all because of the downward trajectory of interest rates. Well, at some point, that's going to go in the wrong direction, and that's not going to be a very pleasant experience when we encounter that, in my opinion.
I just add that all of the long-term pressures that were pushing up the federal deficit, which is the aging population and the pressures of rising medical costs, those are all still there. Those haven't gone away. So those pressures will rise over time. So yes, I think for now, not a problem. Down the road, we got to think about what to do about the potential for a spiraling debt and deficits a few years down the road.
Mm-hmm. What kind of effect will that have on the stock market when all of a sudden those interest rates go up?
Well, it'll certainly have an effect on the bond market. I think that's baked in. The bond math is very dire if you start to project some increases, even increases back to the what would be considered the normal level of the interest rate regimes in the United States. I think there's a potential for some large losses in the bond market. I don't have the wisdom to say how the stock market will react. I think a lot of it is going to have to do with the way the government responds to this, whether it's going to drive higher taxes and lower profits for the corporate sector, or whether, corporate sector is actually, their profit levels have gone up secularly over the past couple of decades quite a bit. They've also levered up quite a bit, and it seems to not be a problem. I think, the comment I would make about the debt question is that I think we've learned a lot about how to manage capital structures compared to where the typical corporate management might have been a few decades back. And I don't want to be Pollyannish, but I think there's more science applied to the issue today, and more ability to hedge risk and more ability to manage risk. Not that everybody's going to do it right and smart, but so I don't know on the stock market, but the bond market, I wouldn't want to be there when this happens.
Mm-hmm. So we have quite a few young people on today's call. And a question just came in of what your advice would be for someone in their 20s who is thinking about investing. And I think that's for all three of you. I think all three of you have some expertise in providing that kind of advice.
It's tough if you're 20, and I'll tell you why. As interest rates are falling from a high level in, say, 1982 to a very low level today, that's going to drive extraordinarily high financial asset returns in the stock market and the bond market. But once you get to this level of interest rates going forward, your financial asset returns are going to be much lower. So the fun part of the ride is probably mostly over. And so I think so as an investor, I think you just have to be realistic about what kind of financial asset returns you're going to make going forward, because interest rates are probably not going to fall significantly further. In fact, interest rates are hopefully going to rise as we look down the road, 4 or 5 years down the road. And so I think, financial asset returns of, if you on a 60-40 stock bond portfolio, if you make 5 or 6% a year, I think you're going to be doing quite well. That's quite low relative to what we've experienced recently.
I would just add that I think the advantage you have if you're in your 20s is that you have time to allow the diversification of the time variable to improve your portfolio performance over a long horizon. One of my Forbes pieces, I document that, and it's quite striking. Most professional investors don't have that advantage because they have shorter time horizons where they have to demonstrate performance. But a retail investor in your 20s, you can take a 20-year perspective, 30-year perspective on the market, and that will be your only advantage over the pros, but it's a very significant one.
I'd also say, make sure you don't just look at the US, that you've got to look globally, because there will be parts of the world where over the longer term, they're going to grow faster than the US, and you can probably get higher returns there. They're more volatile, but if you have a long-term perspective, you can potentially make bigger long-term gains there. So don't just look at the US, but take a global perspective on your investments.
I bet all three of us would say, don't try to time the market.
Oh,
Yeah.
So we have had quite a few questions come in on supply chain, moving from just in time to just in case. And what industries do you see being affected by that? And how is that going to shift economic activity in different countries? Who's going to win? Who's going to lose? Are wages going to go up in the US because of it? You know, there's a whole lot of questions that kind of get involved in that.
I'd say that there's some industries that are immediately affected by the pandemic and the medical side. So there's going to be interest in reducing dependence on overseas sources of PPE equipment, protective equipment, reducing dependence on overseas sources of drugs, for example. So I think that there's one sector that will be very much affected is at the medical side. I think that a lot of the shifts won't necessarily benefit the United States directly, because if you get a shift in activity to bring things closer, then you might have some activities which are brought from potentially China or East Asia to Mexico to be close to the US, but which can still be done at low cost. So I think there will be those sorts of shifts. The shifts benefiting to the US will be more, I think, in cases where you can automate, where you can robotize, where you can use software, artificial intelligence to raise productivity. I don't think it's something that's going to be a huge boost to US employment, but I think that you would see some activity shift in those sectors.
I would just add that I think the really interesting supply chain question, and I'm not an expert in this, but is in the semiconductor industry. And I'm not sure that it's got an easy answer. You can decide you're going to make shoes or clothing or a lot of things in different places, shift production from Asia to Mexico, but the semiconductor industry is in a corner in some respects, and I don't know quite how they're going to manage to get out of it, or whether they can. So that'd be one that I would watch.
A big issue here is the U.S. relations with China and how much we decide to disengage in terms of our reliance on China, in terms of our own economy. And that if we decide to disengage, that's not going to be costless. You think about the Apple phones that are assembled in China. If we decide that somehow they can no longer be assembled in China, they have to move elsewhere, costs are going to go up. So I think we should also recognize that it's not a free lunch. I mean, the globalization has reduced cost to the U.S. consumers, and if we start to pull that apart, there are going to be consequences for productivity and consequences for the price of goods and services. And so that's a really, really important decision, I think, that the incoming Biden administration has to make. Are we going to continue to go down this pathway of two separate paths, or are we going to come back together and support a globalized economic system where you have specialization on the things that you're good at, and you rely on the other people that are good in other things to produce that. That's the law of comparative advantage, which economists, very much endorse.
So the centerpiece of the Biden economic policy proposals are tax increases. Providing they get control of the Senate, would you expect tax increases to pass? And would it be a good idea to increase taxes at this point?
I think even if you get 50-50 in the Senate, it's going to be hard to pass a significant tax increase. I mean, the Biden administration, the Biden campaign said that they weren't going to raise taxes on anybody earning less than $400,000. And if that's the case, I think there's probably political support for that, in the sense that, the income distribution has become much more skewed over the last 2 decades. And that's even been more amplified by the pandemic, which has fallen disproportionately on low and moderate households. So there certainly seems to be a case to made to reorient tax policy to have some consequences on income distribution in the U.S. But whether you can get 50 senators to sign off on that remains to be seen.
I'd say it would be, even if you got 50, you can't necessarily assume that you can bring along all the 50 Democrat senators with whatever the president Biden would like to do, or what he said that he would like to do in his plans. I wonder if maybe we may not actually address these tax issues fully until we get to the end of 2025, which is the point at which the current tax cuts put in place in the 2017 Act, pretty much all of the individual tax cuts in that bill, in that Act, are scheduled to expire at the end of 2025. So at that point, we'll have to address it. I'm not sure whether anything will change before then.
So we have another student question, and that is that the pandemic has had a tremendous impact on higher education. I think most of your schools, or most schools, are sending everybody home at Thanksgiving, and God only knows when they will be coming back. Is this going to have a long-term impact on universities and on the economy?
Well, it certainly is going to have an impact, and some of it will be positive. I think we're discovering, I teach courses that are so-called hybrid courses that have some students in person and some students on Zoom. They're very awkward, that's very difficult to handle. But a lot of the techniques that I've learned, I'm speaking very personally here, to use the online facility to amplify, supplement what I would have done previously. I think I'm going to stay with a lot of those things, and I think a lot of my colleagues are. So there's going to be a broadening of the toolkit for educators that will be a positive outcome. The big impact that we see is not at the undergraduate level, it's at the graduate student level, and that has to do with both political questions about visas and immigration restriction, and maybe the Biden administration will ease some of that. But certainly it's also about travel restrictions and ability of foreign students to even get applications processed at US consulates in some countries that are not fully operational. So hopefully that will go away as the COVID crisis diminishes. But it's very severe at the graduate level. It's very severe.
I would just say that we pay a lot of, our team pays a lot of attention to higher education, and historically you have a standard pattern. If the unemployment rate goes up, the economy goes into recession, higher education enrollments go up. And this time that has been short-circuited because of COVID, particularly people enrolling in two-year schools. we're seeing those enrollments down very, very sharply. So COVID is clearly a big problem for some schools that were already struggling. And the big question will be, can we get that vaccine widely distributed by the middle of next year? If we can, then we have a prospect of people who have deferred this year, some people who deferred this year coming back next year. And probably the unemployment rate is still going to be quite elevated at that point. So there's still an economic incentive for some people to go back to school a year from now in the fall of 2021. So it's really hostage to developments on the vaccine front and whether people feel comfortable going back to school again.
Mm-hmm. Well, we have quite a few more questions, but we are getting towards the end. But I would like to ask one that came in, and that concerns universal basic income. During the Democratic primary, it became a topic of discussion. It's not been really seriously discussed in the United States. It has been in other countries. And I'm just wondering where you think that discussion might go and should go. Is universal basic income an idea worth examining, or is it kind of dead on arrival?
I think it's not going to happen. I don't think there's the political support for it. I mean, look at the results of the election. A lot of people thought that there was a possibility of a blue wave, and there was no blue wave. And so I think if you start talking about, minimum income support, that's just not going to fly politically. And second of all, it's just really expensive. You're really going to give enough income to people so that they can actually live without working. That's potentially a lot of money. So I don't know what Nigel and George think, but I think it's, it's a discussion item, but I don't think it's going to happen anytime soon, in my opinion.
Seems very, very unlikely for the United States. And maybe there will be experiments in other countries that the US can look at and potentially learn from as we think about this. But in sort of the foreseeable political future, I think a non-starter in the US.
Yeah, I agree with the comment foreseeable future. I'll just add, though, that if you take a very long view, we're in a state today in the US where we pay farmers not to grow things, not to be farmers. As technology proceeds, and there are all kinds of trends you can look at in manufacturing and the employment levels and so forth, a century down the road, not our problem, but the next administrations or so down the road, I think are going to deal with a situation where they don't need all the labor in the economy. And what do you do to balance the income levels when you don't need the farmers to farm? Well, in the farming case, they all went to the city and went into other occupations, but there may be something down the road, but I think it's well past our horizon of immediate concern.
Well, I want to take the opportunity to thank the three of you. I think this has been a fascinating discussion. And since I have to give an economic outlook presentation next week, you guys gave me lots of information and things to talk about. I really appreciate that. I want to remind everyone that this is the first of a series of discussions that we will be co-hosting with the Independent College Association here in New Jersey. We are planning that our next one will be the future of polling, which is a very important topic, especially given how off-base the polling has been in the last couple of presidential elections. So again, I want to thank everybody, but especially our panelists, Nigel, Bill, and George. Excellent job, just a really good discussion, and I appreciate it tremendously. We do have the slides from Nigel and from George, so if anybody would like copies of those, they can either give us their email address in the chat or send us an email, and we would be happy to send those on. Thank you.
Peace.
Bye-bye.